Now on Sky News Business, your property empire.
Hello and welcome to your Property Empire. I'm Natalie MacDonald, filling in for Chris Gray today. Well, on tonight's show, what is mandatory comprehensive reporting and how will it affect you as a buyer of property? What might you have to do in the future in order to get an interest-only loan instead of being forced to go principal and interest? And when will lending conditions likely ease up? Well, joining us tonight is John Machimelli from Hunterwood Solutions Mortgage Brokers and also Charles Tarbey, Chairman and owner of Century 21 Australasia. Well, John, we're going to start with you, and one of the topics that we are discussing this evening is mandatory comprehensive reporting. What is it, and also why has it come about?
Yeah, good question. I think we forgot about it. It was introduced earlier this year, and what Scott Morrison was trying to do was introduce competition into the marketplace. At the moment, when you get a loan, there's really just negative reporting. So when you go to apply for finance, on your Vita report is only negative incidences. So what Scott was trying to do was say, let's get positive reporting into place. And so the banks are now, all lenders or anyone that has credit facilities shares data. And the idea is that with positive data, there is an opportunity for better interest rates, the ability to get that next loan and so forth. So it really was a federal initiative, and it was designed to improve competition and get a better deal in place for consumers.
Now, it really seemed to initially at least target the big four banks, and there was quite a positive reaction, it seemed, from some of the smaller lenders. But what sort of reception more broadly has been seen?
Well, the idea was the banks were supposed to behave, and they didn't. And what happened was only 1% of positive data was being reported. And so Scott Morrison said, naughty boys and girls, you're going to have to now behave. And so he's introduced mandatory data. So come July next year, some of the biggest changes will come into effect, and the big four basically have to play ball now. So they have to play. So 50% of all compulsory or data now needs to be provided to other lenders. So if you and I were applying for a loan, and we had a history of credit with some other utilities, credit cards and things like that, that lender can now ask for information, because all lenders keep history on our credit.
Yeah.
And so the idea is that the big banks are going to be forced to play. They've got the resources to put resources in there and help us. But the smaller lenders have got a bit more time. They've got about a year to go before they have to get involved in that space.
And in fact, there do seem to be a couple of the smaller lenders already that are implementing that, and they're getting on board.
Good to see.
What does it mean then, if we flip this side of the argument, what does it actually mean then for property investors and those getting into this market?
Well, as you know, Natalie, it's very difficult at the moment. I've never seen, in 15 years of doing this, I've never seen it so hard. So let's pick on Chris, because he's not here, Charles, shall we?
We always do.
Yeah. So when Chris goes to apply for that next loan, he's not going to just apply for, with pay slips and things like that. The banks are actually going to see how good or how bad a credit risk he is. So all the lenders that he's applied for in the past, has he got good credit history? Because at the moment, the banks really don't know.
But that's not a bad thing, because at the end of the day, it's going to make it a lot easier. There are going to be people who are going to get better loans. There are going to be other smaller banks that are going to be able to compete, and because they'll understand what's really going on. So I think it opens up the doors for the consumer to get a better deal all the way around.
Those borrowers trying to chase those better lending rates.
Yeah.
Yes.
And there'll be more innovation too, Natalie, because there'll be a richer data set there, and there'll be some clever people that'll get in there and go, right, we can reward the very good customers. The only caveat is, those customers who've had a little bit of a checkered history may go against them, so it remains to be seen. Well,
just with that in mind, actually, in terms of diving into this in a little bit more detail, I mean, what is sort of the devil in the detail, as it were, for, yes, those who have both good and bad credit history?
Yeah, so look, at the moment, your Vita report basically says if there's been bad incidences, but it doesn't tell you exactly what's been going on. So if you're applying for credit and you're consistently late, and there's been numerous calls, then the banks will have access to that information now to say, well, hang on, people are constantly chasing you to make those repayments. And you have been making them on time, but it's been very difficult. They may price that lending a little bit higher. So it remains to be seen anyway.
Over what sort of time period do we look at with this? Because you have, and you see it online, all those items where you can do a quick fix, credit fix, and that kind of thing. If you have been running up a few of the credit cards, more negatively speaking, I mean, how longer term does this price action look?
For 24 months, essentially. The data is there to show 24 months of recent history. Now, I think it's a positive thing. I think for the majority of people, this is going to be an amazingly good thing. For us property investors, if you've had a history of really good, borrowings, and you've made some money and you continue to use increasing equity to borrow, this is a fantastic thing. I'm looking forward to it. So mandatory reporting will start in July of next year. Yeah, the banks haven't been playing ball. So,
you're speaking about it very, very positively, and as we've discussed in terms of those borrowers who are looking for those better lending rates and competition, but are there negatives to this?
I think, yeah, I just worry about those fringes of society where there's more data that may punish them a little bit more. So if there was ever a time to make sure you pay your utility bill, if there was ever a time to let all the utility companies know that you've moved, you've got to do that.
Yeah.
Because there's been a time and time again people have moved and they've forgotten to tell the utilities.
But this is all part of the whole process that started with regards to responsible lending too. You go all the way back, and if they're going to talk about responsible lending, they've got to go all the way. And anybody that has had a problem has got a chance to fix it. You can go back to the different bodies and get your name removed from lists and so on. And sometimes that's probably what you need to do, just to clean things up and get it together. But realistically, the banks needed to be made accountable, and this was the only way. And they weren't playing ball, as John said, and so it's been forced upon them. I think they didn't even get anywhere near their targets. It
was 1%.
Was it 1%? You said that before. 1%. I didn't realise it was that
Scott
low.
Morrison wanted to have a good 50%.
Yeah.
So he's now mandated that by July the 1st that 50% of our data needs to be made available.
It's very interesting how the current government is really putting pressure on banks in so many different ways. This is not the first part, because we looked at the tax that they introduced recently as well. So the banks are, I don't know whether this is a popular thing to do with the current government or not, but it certainly is letting everybody know that the banks aren't going to get away with making big profits and not reporting effectively.
There is some sort of suggestion there. It does bow to that social pressure that the government is coming under when it does come to the banks.
Banks are a good target. And, well, I mean, the poor buggers, they've got to report. When they report to their shareholders that they've done exceptionally well, that's because they love to do that, because their bonuses are paid on that. That's a double-edged sword. They cop it at the other end as well.
Well, just to come back to a point that you made a little bit earlier in terms of those on the fringes of society and, of course, it not benefiting them so well, those who have had missed payments or haven't performed so well. Now, something, John, that you and I are going to be talking a little bit later is the latest that we've seen coming through from APRA. Charles, keen to get your take on that. There has been a warning surrounding that impact that we could see should we have some instability within the housing market. Is this a way not only to increase competition but also to add that layer of security for the big banks and for the broader system? I
think it's necessary because we did get out of control. The interest rate reductions that took place over the last few years, I think the last couple shouldn't have occurred. Not for they occurred for economic reasons, but they shouldn't have occurred for real estate reasons. And it caused people to move just a little bit further than they should. And the warning on fixed loans, people still taking up fixed loans. Look, in 3 years' time or 5 years' time when a fixed loan is expired, what's the interest rate landscape going to look like then? Is going to be 2% higher, and people haven't reduced their debt levels. And so I think we could be in for a bit of a problem, especially with the influx of apartments off the plan that may not settle, may not complete coming up.
Well, it's interesting you should say that, Charles, because APRA came out the last 2 days saying they want lenders to be a lot more methodical with income and expenses. So moving forward over the next 6 months, the lenders and brokers need to justify their lending, and they really need to go. We need to go into the expenses and income now. We never had to do that before.
Okay.
So
will that create the idea then that you're going to see borrowers having to jump through even more hoops than they already are?
Not Natalie.
Me too, as a prospective first-home buyer myself.
So it's pretty hard at the moment, but look, there is good news. There is, it is thawing out, by the way. There is this. It's a fascinating time, to be honest, in finance. Just literally half an hour ago, AMP announced it back in the refinance and investment property market. I haven't seen that in a while. AMP have hit their targets to stay under the APRA limits, and they said we're back. Thursday, I was at a conference in the Hunter Valley, and NAB announced they're back in the game of investment lending. So it's an amazing time where there's just lenders pulling out and pulling back in. So just speak to a good mortgage broker who specialises in the investment property space, and they will be able to help you. With 26 lenders on your panel, there's always a solution there.
Well, just with that in mind, actually, I mean, let's touch base in terms of how a lot of this dialogue and how these measures are feeding through. Charles, what are you seeing taking place sort of around Australia at the moment?
It's an incredibly strange variety of circumstances. There are people in parts of Australia that have now got negative equity, so if interest rates change, that's going to impact on them very, very heavily. So I think that's a real balancing act right now for the RBA as to which way they go, and particularly the talk of US markets interest rates being increased. We've got to start to compete. I really don't know, but I can just say to you that we all talk about 1,000 different marketplaces in Australia, and it's pretty much like that. Everyone's different.
Of course. So let's go through some of the classics that we look at then in terms of what we're seeing in terms of clearance rates at the moment.
Yeah, we've got the charts for clearance rates, and they're really interesting. They've been changing quite significantly in a downward trend, and again, I don't mind that situation or that position. The clearance rates for the country nationally were 66.9% in this last week, slightly up over last week. It was 73% this time last year, so they are down. And Sydney, well, that's been one of the most interesting ones. Up until we count everything by Thursday, this was their clearance rates were down to 66.2%, and Sydney had 1,200 auctions. Melbourne, it was down.
Still pretty healthy.
I know, but Melbourne's down to 69. That was always in the early 70s and up, and their auction numbers were 1,727, so they had a significant number. But again, second week in a row, Adelaide, Perth, those two, and Darwin, those three. Adelaide, Perth, and Brisbane, those three capital cities had an increase in their clearance rates over this time last year. That's 2 weeks in a row. So they're on the climb, and the other two capital cities I've mentioned are on the way down.
So does that suggest that we're seeing this move away from what have been those traditional hubs?
Yes, very much so. I think Melbourne's the last one to go. It took off because the prices are so fantastic there, and Hobart followed suit because of the equity coming out of Melbourne into Hobart. Now that Hobart last week had the best clearance rate, so you can see it all moving out. So now we're watching it. I think we're going to see a good solid slowdown, but a slowdown to the point where the real estate market is an established one with modest growth, and people can pop in and make an offer on a property and not have to rush into that auction process.
In terms of then, I guess, the health of the market and how sellers are feeling, I mean, how many homes are we seeing advertised for sale at the moment comparatively?
We have had, again, the chart for that. It's been climb every week. Coming into Christmas, we're in negative territory this week, so it's come in at 0.52% down, but each other week up, leading up until now, has been, a positive one. I don't expect much stock to come on the market over the next few weeks, and then we'll see that ramp up again in around January of next year.
And what, of course, we look at on the show is not just when it comes to those properties for sale, but also what we're seeing in terms of rental price movement as well within the rental market.
Yeah, and that's been really an interesting one for me to watch, because I've been keeping these charts for 5 years every week around clearance rates, listings, rent movement and vacancy rates, and the rent one right now is pretty stable. There's not a lot happening. We saw a little bit of growth in Hobart. It went negative again, but it went up again. So Hobart's been the best performing capital city of all in terms of rent increases, but overall in this last week on week, not much movement at all.
Of course, in terms of also how that's translating into, are we seeing more people moving into, purchased homes, or are they staying in rental properties?
Yeah, the vacancy rates they've been really difficult for a lot of people, for a lot of tenants, and that's been causing people to, if they've got somewhere, they'll stay if they can. But the vacancy rates, Melbourne was the winning capital city for most weeks, but the last 2 weeks Sydney's had a fight back at 0.81% vacancy. I mean, less than 1% of the properties are vacant, and Melbourne was 0.99% in this last week. But the one that I study very, very closely, because it was up in the 10s, vacancy rate, is Perth, came back 6.17% this week, which is absolutely fantastic. So the three capital cities combined at 2.66% vacancy rates.
Charles, what about Brisbane? It's, there's been a flavour of a month there, and
I'm cautious about Brisbane at the moment because of the apartment situation. But other than that, Brisbane's a great place to buy. Yeah, great. Just got to watch it.
Well, Charles, you have to dash off. But we appreciate you joining us this evening. Thank you so much.
Thanks.
Well, we're going to take a short break, but we will be back very shortly. You're watching Your Property Empire.